Nifty has delivered solid returns over the years, but if you zoom out globally, names like Nvidia, Apple, and Microsoft have powered a huge share of worldwide wealth creation over the last decade. So a question many Indian investors are asking in 2026 is simple: should I look beyond India? Hi, welcome to day 1 of our 30-day US stock series for Indian investors. I'm not here to sell you a dream. I'm here to give you a structured, honest map of why US markets matter and how platforms like CoinDCX and CoinSwitch fit into the picture from India. Let's start with 3 real reasons Indians explore US stocks. Reason 1: diversification. Your salary, your home loan, your mutual funds, a lot of your financial life is already tied to India. Adding US exposure means you're not betting everything on one economy, one currency, and one market cycle. When Nifty struggles, US tech doesn't always move the same way, and that's the point. Reason 2: currency exposure. The rupee has gradually weakened against the US dollar over long periods. When you hold or track US assets, you're also getting exposure to the world's primary reserve currency. That's not a guarantee of profit. Currencies move both ways, but it's a factor many long-term investors think about. Reason 3: access to global leaders. The US market is home to the companies that dominate AI, cloud computing, smartphones, e-commerce, and digital advertising. Nvidia for AI chips, Apple for consumer tech, Microsoft for enterprise cloud. These aren't just tickers on a screen, they're the businesses shaping the global economy. Indian investors want access to that growth story. Now, how do you actually get exposure from India? Broadly, there are 2 paths. Path A: ownership. You remit money abroad under the Liberalized Remittance Scheme, LRS, open a US brokerage account through platforms like Vested or Grow International, buy real shares in USD, and hold them. You get dividends, voting rights in theory, and SEP protection on eligible US brokerage accounts. This is the long-term investor route. Path B: price exposure. You don't buy the share certificate. You trade a derivative contract that tracks the price, settled in rupees, on your phone, often 24 hours a day. That's what CoinDCX US stock futures offer. You can go long if you're bullish, or short if you think the price will fall. Minimum can be as low as 100 rupees. But, and this is critical, you do not own the stock. No dividends. No shareholder rights. And leverage can wipe you out fast. So who is this series for? If you're a 22 to 40-year-old Indian who wants clear, platform-specific guidance, not random Telegram tips, you're in the right place. Over 30 days we'll cover CoinDCX futures mechanics, CoinSwitch's free education hub, how to read NVDA and APL charts, risk management, taxes, and building a real plan. We're not promising returns. Derivatives carry high risk, including liquidation. This is education, not financial advice. Save this video. Tomorrow on day 2, we'll map exactly how CoinDCX and CoinSwitch work together, and which one fits your goal. Follow so you don't miss it.